innovation has always been the most misunderstood engine of economic growth, not because it is rare, but because it is uneven, disruptive, and deeply uncomfortable for the societies it transforms. When I look across financial history, I do not see innovation as a parade of heroic inventors or sudden breakthroughs. I see it as pressure released through necessity, ambition, and fear. Innovation is not simply about creating new things. It is about rearranging power, reallocating labor, and redefining what counts as value and economic growth is the visible wake left behind by that deeper rearrangement. In the ancient world, innovation was slow, incremental, and often invisible, yet its impact was profound. The plow irrigation systems, standardized weights, and coinage did not merely improve efficiency. They expanded the scale at which economies could function. Surplus became possible, and surplus changed everything. It allowed specialization, urbanization, and the emergence of trade networks that stretched beyond kinship and tribe. Growth in this era was not explosive, but it was cumulative. Each improvement widened the margin between subsistence and collapse, giving societies room to experiment. Innovation here was conservative in spirit, focused on survival rather than disruption. Yet it laid the foundation for every economic system that followed. The medieval period reminds us that innovation does not advance uniformly. Europe stagnated in some respects, while advancing quietly in others. The heavy plow, three-field crop rotation watermills and windmills increased productivity long before markets were ready to capitalize on them fully. What limited growth was not the absence of ideas, but the rigidity of social structures. Innovation without institutional flexibility produces frustration rather than growth. This lesson echoes throughout history. Technology alone does not create prosperity. It must be absorbed by systems willing to change. The early modern era marked a turning point when innovation began to accelerate alongside capitalism itself. Navigation tools, shipbuilding advances, accounting methods, and financial instruments expanded trade and reduced uncertainty. Double-entry bookkeeping, often overlooked, was as revolutionary as any machine. It allowed firms to track profit and loss, systematically encouraging investment and long-term planning. Growth here was not just material, it was psychological. People began to imagine the future as improvable through calculation rather than fate. Innovation reshaped expectations, and expectations reshaped behavior. The Industrial Revolution stands as the most dramatic illustration of innovation-driven growth, but also of its costs. Steam power, mechanized production, and fossil fuels unleashed productivity on an unprecedented scale. Output soared, prices fell, markets expanded. Yet this growth was uneven and violent in its social impact. Skilled labor was displaced. Cities swelled faster than infrastructure could handle. Wealth concentrated before it diffused. Innovation did not lift all boats simultaneously. It capsized many before stabilizing the waters. History insists we remember this, because every era tends to celebrate innovation's winners and forget its casualties. What made industrial innovation different was not invention alone, but feedback. New technologies created profits that funded further experimentation. Growth became self-reinforcing. This dynamic transformed innovation from an occasional event into a continuous process. Economies no longer waited for breakthroughs. They organized themselves to produce them. Research patents corporations and capital markets formed an ecosystem designed to turn ideas into output at scale. Growth rates rose not because humans became smarter, but because systems became better at amplifying insight. The 20th century deepened this relationship. Electrification, chemicals, aviation, and mass production reshaped not just industries, but daily life. Innovation became institutionalized through corporate R&D and state-sponsored research, especially during wartime. World wars accelerated technological development at enormous human cost, but they also demonstrated how rapidly economies could be transformed when survival demanded it. Post-war growth owed as much to these accumulated innovations as to Reconstruction itself. The so-called Golden Age was built on decades of technological groundwork. Yet history also shows that innovation's contribution to growth is not constant. By the late 20th century, advanced economies began to experience slower productivity gains despite rapid technological change. Computers, the internet, and automation transformed communication and services, but their impact on measured growth appeared muted compared to earlier industrial breakthroughs. This puzzled economists and excited investors. The gap between technological spectacle and economic statistics widened. Once again, history offers perspective. Not all innovations translate immediately into broad productivity. Some rearrange consumption leisure and power before they reshape output. Innovation also carries a paradox at the heart of capitalism. It creates growth by destroying existing value. Joseph Schumpeter called this creative destruction, but history reminds us that destruction is not merely metaphorical. Jobs vanish, skills become obsolete, regions decline. The political backlash against innovation is therefore not irrational. It is historically predictable. Societies that fail to manage this transition pay a high price in instability. Growth that ignores distribution eventually undermines itself. Perhaps the most overlooked aspect of innovation is its dependence on context. The same technology can produce vastly different outcomes depending on institutions, education, finance, and culture. Railroads unified some economies and bankrupted others. Industrialization enriched certain nations while colonizing or marginalizing others. Innovation does not guarantee convergence. It often amplifies existing inequalities before correcting them, if correction comes at all. This is why growth driven by innovation feels miraculous in hindsight and chaotic in real time. As we stand today amid artificial intelligence, biotechnology, and digital platforms, the question is not whether innovation will drive growth, but whose growth it will drive, and at what cost. History cautions against simple optimism and simple fear alike. Innovation is neither savior nor villain. It is a force that magnifies human intention and institutional design. Where systems channel its gains broadly, growth feels inclusive. Where they do not, growth feels hollow and fragile. And it is here, at this unresolved tension between possibility and disruption, that the role of innovation in economic growth must be understood not as a technical issue, but as a historical choice, because every era decides whether innovation will be allowed to concentrate power or compelled to diffuse opportunity, and that decision determines whether growth becomes a foundation for stability or a prelude to crisis, as the next wave of transformation gathers momentum and the story continues into the next phase of history, where innovation accelerates faster than social adaptation and the familiar questions return with sharper urgency. As the 21st century unfolds, innovation no longer arrives in waves separated by generations. It arrives continuously compressing adjustment into ever shorter windows. This changes the relationship between innovation and growth in a fundamental way. When change is constant, economies struggle not to invent, but to absorb. Growth becomes less about producing more and more about managing transition without fracture. Artificial intelligence, automation, and digital platforms illustrate this tension clearly. These innovations promise extraordinary productivity gains, yet their distribution is uncertain. They concentrate returns among those who own data algorithms and networks, while displacing tasks faster than labor markets can retrain. History teaches us that such moments are decisive. When societies fail to build bridges between old skills and new demand, innovation fuels resentment rather than prosperity. Growth statistics may rise, but legitimacy erodes beneath them. At the same time, innovation reshapes the very metrics by which growth is measured. Many digital advances improve quality access and convenience without appearing fully in GDP. This creates the illusion of stagnation even as life changes rapidly. Similar debates occurred during earlier technological transitions, when new forms of value were invisible to old accounting. History cautions us not to mistake measurement problems for absence of progress, nor spectacle for substance. Growth has always been partly a narrative constructed around what societies choose to count. The role of the state becomes critical in this phase. Contrary to the myth of lone inventors and free markets, every major wave of innovation has been supported, guided, or constrained by public action. Education systems supply skills. Infrastructure enables diffusion. Regulation shapes incentives. When the state withdraws entirely, innovation does not stop. It concentrates. When the state overreaches, innovation slows or migrates. The balance is delicate, and history shows it must be renegotiated repeatedly as technologies evolve. Innovation also interacts with demographics and inequality in ways that shape long-term growth. Societies with aging populations face different innovation imperatives than young ones. Economies with extreme inequality struggle to translate technological potential into broad demand. Growth requires not just new supply, but consumers able and willing to absorb it. This was true in the industrial age, the post-war boom, and it remains true now. Innovation without purchasing power leads to excess capacity and instability. Perhaps the most important lesson history offers is that innovation-driven growth is not automatic or permanent. It must be cultivated, and its fruits must be shared to sustain momentum. When innovation is allowed to hollow out labor markets or undermine trust, backlash follows. When it is harnessed to expand capability and security, growth becomes durable. This is not an argument against disruption, but for stewardship. As we look forward, the question is not whether innovation will continue, it always has, but whether societies will remember what past transformations taught them. Growth emerges not from invention alone, but from the alignment of technology, institutions, and social trust. Lose any one of these, and innovation becomes noise rather than progress. If this exploration of innovation's role in economic growth has deepened your understanding of how economies evolve, I invite you to subscribe and continue these journeys through financial history with me, and to leave a comment sharing which modern innovation you believe will most reshape growth in the coming decades, because history reminds us that the future is never decided by ideas alone, but by how societies choose to live with them.